Life insurance, the unholy Trinity. Ooh, scary stuff, isn't it? It actually should be scary. Probably not in this current tax environment, but certainly if we go forward and the feds realize they need more money to fund the big unfunded liabilities of Social Security, Medicare, Medicaid. There'll be more estate tax coming down the pike, more gift tax coming down the pike. So just keep that in mind as you're looking at how your life insurance policies are set up. All right. So generally speaking, what happens is we have life insurance. I have a policy. I'm the insured. I'm the owner, and Charlotte is the beneficiary. That's literally how it usually works. Husband, wife, it's almost like an I love you will. Josh has this stuff. Charlotte has this stuff. At my death, I give it to Charlotte. When she dies, she gives it to the kids. That's called an I love you will. Very simple. Life insurance is the same thing. I own it. I'm the insured. At my death, my spouse is the beneficiary. All right. What happens if you don't have a spouse? Whatever reason it is, what happens if you don't have a spouse? All right, so this is what we're going to show you here. So typically, this is how it works. I am the owner and I am the insured. So your old buddy Josh owns the life insurance policy, and I'm also the insured. At my death, I give it to my kids, my little tax credits here, and they all get $750,000 each because they got a $3 million life insurance policy here. Actually, I just did a quote from Policy Genius, and it was $600. It was what the cost was for $3 million for a 25-year term. Now, typically, if you're doing estate planning, you're not really going to use a term policy for the estate planning. It doesn't make sense because the vast majority of people survive their term policies before it gets prohibitively expensive. So I emailed Policy Genius and I said, hey, do you all have second to die life insurance policies? I'm telling you, man, you got to be careful in this stuff. And they said, no, we don't offer joint policies, but we would advise having two individual policies instead of a joint one. That's the wrong flipping answer, man. That annoys me. That's the wrong answer. So I don't know if that guy's a rookie. I obviously don't offer second die life insurance policies, so they're going to advise you on other things. If you're doing life insurance as part of a state, you're not doing second die life insurance, there's absolutely no reason at all to have two individual joint life insurance. I'm stunned to hear that, but I'm frankly not really that stunned. Anyway, I'll go into a different video on that later. All right, so here's how it works. All right, so I got 4 kids. I die. I got a $3 million policy. I'm only paying $600 a month for it. So just as an FYI, we're paying. You can figure that's what makes term so beneficial. Is that I pay 6 times $7,200 out of my first year, and I get a $3 million life insurance payout to my kids. You can't beat that rate of return. The drawback, of course, is I'm dead. All right, so that's why term is so cheap, because it's not likely for me to die before the term is up. But what will happen with this $3 million? Well, it's going to be part of my estate. So let's just say I live in a state like Massachusetts, or what's the other ones? Is it Connecticut anymore? Oregon, Rhode Island. I immediately have a taxable estate. I can't remember what New York was off the top of my head. I immediately have a pretty significant taxable estate just on this life insurance alone. So if I have life insurance and IRA money and 401k money and a home and other assets, you can quickly see how you have a taxable estate. Now, if it just goes to my wife, it won't matter. But again, my wife is no longer. So I have no wife. It goes to my kids, completely taxable. So what a lot of people do is say, no, I don't want that to happen. I'm going to rename the insurance. I'm going to make, we'll just say Maddie. Let me get my other pen. We'll name my oldest, and this happens all the time. We'll name Maddie the owner. All right, so now I am no longer the owner. I'm just the insured. All right, so that's no big deal. And on something like that, the gift on that is literally you typically don't want to name Maddie the owner after you've already bought the policy, because there is a gift presumption there that could have some significance. So we're going to say I just out of the gate, I had Maddie as the owner here to avoid the issue of gifting a term. It's not much, and I just don't want to get too deep into that. But when you're gifting something to somebody that has a value to it, in theory, there is a estate tax or a gift tax consequence. I don't think it'd be a big deal here, but we're just going to say out the gate, I bought an insurance policy, and Maddie was the owner. My oldest daughter was the owner. All right. So let's read you verbatim what happens when I die. So old Josh, I'm dead. All right. So that $3 million actually comes in for it comes due. All right, so my kids are going to get $750,000 each. Sounds great, but let's just read you what happens from right there. Let's see. Terry wants to insure her life for $3 million. She recognizes that life insurance will create a source of liquid assets that will allow her family to pay estate taxes after her death. Her oldest son, Nathan, is named as owner of the $3 million policy. Beneficiaries of the policy are Nathan and his two siblings, Zachariah and Alexander. Terry doesn't see the need for paying the expense of creating irrevocable life insurance trust, since Nathan can hold the policy for the benefit of himself and his brothers. And upon Terry's death, the $3 million will be paid in equal shares to Nathan, Zachariah, and Alexander. It will not be included in her estate. In this case, it won't be included in my estate because Maddie is the owner. It can't include a estate tax on something that I don't own. Only Maddie owns it, thus it's not included in my estate, which, hey, that's great. Except for the fact that, let's see, upon Terry's death, the $3 million will be paid in equal shares to the three siblings, which includes one is Nathan. In my case, the $3 million will be paid in 4 equal sums to my 4 kids, with Maddie as the owner. So my other 3 will get it, and Maddie will too, each $750,000 each. But to Maddie's surprise, as the owner of the life insurance policy, she will be deemed to have made taxable gifts of $2.25 million. $2.25 million to her brothers and sisters when the death benefit is paid. Crazy, huh? So forget the irrevocable life insurance for just a second. You're saying, I will maybe get into that here in just a second, but in this case, Maddie, as the owner, when it's paid out, is going to have 3 taxable gifts of 1, of 2. Well, I keep messing with my other pen. Oh, right there. Keep grabbing the wrong pen. She's going to have $2.25 million of gift tax that's due. Now, again, that might not be a big deal in today's tax code. $750 and $750. $2.25 million gift. Now, that won't be a gift tax due on $2.25 million. This would be a gift tax that would be equated on $2.25 million. Right now, the gift tax, I think, is at 40%. Now, today it won't matter. Why? Because the gift tax right now is $11 million. The exemption is like $11 million. So it will have no effect on her gift tax because she has a $11 million exemption over the course of her life. But her gift tax exemption will be reduced by that amount. Again, not a big deal. I get it, because what's the likelihood of Maddie giving another $8 million over the course of her life? Probably minimal. But in the future, it could be a big deal. In the future, the gift tax, right now, Connecticut is really the only state that has a gift tax. So if she were to die in Connecticut, I mean, if this were to happen in Connecticut, she still wouldn't be subject to a gift tax. Essentially, it'd be tax-free. But she would lose $2.25 million over overall lifetime exemptions. So let's just say, 10 years from now, we have a very tax-heavy, friendly Congress and president in there, and they say, hey, we're going to reduce your lifetime of gift tax exclusions to $2 million. Well, now everything Maddie gives beyond the annual exclusion amount, which this year is $15,000, would be subject to gift tax, because this $2.25 million has completely wiped out her lifetime gift tax exclusion. I hope that makes sense. There's a lot going on there, but I'm telling you, this is the unholy trinity. The unholy trinity, right now, it's not a big deal. You're not going to hear a lot of estate planning simply because you have such a big estate exemption, such a big gift tax exemption. In 2013, Minnesota, under that crazy Governor Dayton, passed and had legislation for a gift tax. It literally, they drove people out of the state, so they got rid of it, thankfully. But still, that's how the ignorant among our population, voting population on the left in particularly, they don't recognize that. They think, hey, if you're giving $1 million, hey, why can't you part with 30% of that? It's no big deal. They don't recognize that people get really upset by gift tax, and they're going to do whatever they can to avoid it for sure. Because they say, wait a second, man, this is my hard-earned money. Why should I gift it to? Why should I have to pay a gift tax to you? Look, they don't like that. That's just all there is to it. They don't like estate tax. They don't like gift tax. Estate tax is one thing because you're dead. Nothing you can do about it at that point. When the estate has got to settle, you're too late. It's just done. But a gift tax, you pay it while you're alive. And if you're thinking about transferring of assets and ownership while you're alive, the first thing you're going to do is say, what happens if I transfer these assets, the ownership of the assets right now? Well, you're going to pay 30%. You're like, screw that. I'm going to move to freaking Indiana or whatever, in Montana. I don't know what's next to Minnesota, Wisconsin. They don't have a gift tax. And that can transfer tax free. And that's what happened in Minnesota. And so they repealed it. It's kind of like the old yacht tax. You might not remember the luxury tax, but the Democrats again thought it'd make sense to pass a luxury tax on yachts. And what happened then is no one bought yachts. And so essentially all the boat builders were put out of work because they had no yachts to build because it was a yacht tax, a luxury tax. So what sounds good in theory never works the way they intend. There's always unintended consequence. So this is the unholy trinity. So at the end of the day, what do? Well, in this case, you don't want to change ownership. I still be owner, all right? Now, if I'm owner and I die, and it gives right there to those four, so let's just go back to what it was. Now, again, this depends because it depends on what the gift tax rates are versus the estate tax rate. If there are an estate tax rate, I don't know. But if I'm the owner of this $3 million policy, and it transfers 2, 3, 4, that would, again, it depends on what the estate tax is. Is the estate tax higher, lower than the gift tax? Is the estate tax even applicable here? Because in this case, it's not. The gift tax isn't applicable either. But right now, we have an estate tax that's significantly higher than a gift tax for a husband and wife. And I'm not going to go too deeply into that. But you got to understand how this works. What's the ramification if I move to Massachusetts? All right, so if I move to Massachusetts, this doesn't make sense because I'm the owner of the estate, I'm the owner of the money. All right, at my death, all that's subject to gift of estate tax. If I'd given that to Maddie to be the owner, all right, she's the owner now, and she transfers it, that's completely tax-free because it's not subject to the estate. Because when I die, if Maddie is the owner, she's essentially given that $2.25 million to these people. So it completely depends on your estate, what your state situation is, where you live. You got to understand how this works, especially life insurance, because life insurance can provide a pretty significant estate at your death. So just keep that in mind. That's the unholy trinity. Josh is the insured. Kid number 1 is the owner because I want it out of my estate. Kids 1, 2, 3, 4 are the beneficiaries. That is unholy trinity. Could lead to significant gift tax when I die, and the owner of this case, kid 1, has to transfer some of the benefits, the account value, the life insurance proceeds to the other kids. That is a gift tax. So just keep that in mind. All right, we'll see you next time.